Hi, my name is Paul, and since Goeasy's first quarter results, the shares are up over 23% and still going. So in this video, I'm going to be covering Goeasy's second quarter financial results and conference call, and then I'll briefly go over the stock's valuation and whether I'm looking to buy, hold, or sell the stock. But really quickly, for anyone who might have clicked on the video not knowing anything about Goeasy, Goeasy is a Canadian company that trades on the Toronto Stock Exchange under the ticker symbol GSY. Goeasy's business has two main segments: the Easy Financial segment, which offers different types of loans and ancillary products to people who have less than ideal credit scores, and the Easy Home segment, which offers lease-to-own furniture, appliances, and electronics. These segments operate out of physical retail branches as well as through their own online platform and through partnerships with merchants at the point of sale, both online and in person. Finally, Goeasy's business model is designed to provide flexible and easy to understand lending services to customers who would otherwise be taken advantage of by predatory payday lenders. Getting into the report, which is available for download on Goeasy's website, this quarter started off on a pretty good foot, with the gross consumer loans receivable increasing by 35% on the year, going from $2.3 billion in Q2 of last year up to $3.2 billion. But this number only accounts for the total value owed by Goeasy's customers. So while it is indicative of the growth in the total amount of money that the company can expect to collect, it doesn't necessarily translate into organic growth of the business. For instance, delinquencies and even partial payments will result in a greater total amount of money that can be expected to be repaid. And this can actually increase the total value of a company's loan book in some cases. And if that's what's happening here, then this could actually be an early warning sign of future problems, if there isn't also growth coming from new loans that are being written. Thankfully, Goeasy's business has been expanding quite nicely, and this time around, they managed to achieve a record quarter for loan originations, coming in at $667 million, which was up about 6.1% from last year's $628 million. So everything here seems to be growing, though noticeably a bit slower than in recent quarters, at least in regards to the value of the new loans that are being written. Noting that, the higher past growth rates of loan originations are partially explainable as having to do with the acquisition of LendCare and gaining access to its customer base in Q2 of 2021, which gave favorable comparisons. Additionally, this partially has to do with Goeasy's focus on achieving more loan book stability by undertaking a larger percentage of secured loans and turning down more customers who would require higher APRs on similarly sized borrowings. Achieving higher interest rates on the same lending does of course sound great since it creates higher origination values, but the reality is that these higher interest rates are being charged for a reason, and that is to offset the higher percentages of delinquency and default that come along with offering unsecured loans to people who have a history of bad credit. So when we take into account the fact that secured loans tend to create lower origination values, there was still a fair amount of growth in the quarter. It's just not the sort of growth that's easily visible in the originations metric. See, this quarter Goeasy acquired 42,000 new customers, and they had a record quarter for loan applications, amounting to a 25% year-over-year increase, which was much more in line with the sort of originations growth that was experienced in recent quarters. In addition to that, the company managed to increase the secured percentage of its loan book to 41.2%, which is up from 36.1% in the same quarter last year. That means that this growth came in spite of Goeasy being more selective with its customers and in spite of lower loan values thanks to more of the underwritten loans being secured by collateral. So there is still growing demand for Goeasy's loan products. Now, to speak a little bit more on the topic of Goeasy's focus on higher quality loans, on the conference call we were told that the management is choosing to be more selective as consumer loan demand continues to grow. This way, the company will be able to achieve more profitable loans that will require less in loan loss provisions, which did also decrease by about 26 basis points from where the company was at this point last year. Meanwhile, net charge-offs and total delinquencies were once again in line with previous quarters. So, as we'd probably expect, this continued growth in consumer loans did result in record quarterly revenue growth of 20.4%, or about $303 million, versus the $252 million made in Q2 of 2022. Jumping over to the operating expenses, here we can see that the bad debts did increase by $16.7 million, or 24.6%. This was explained as having mostly to do with the growing size of Goeasy's loan book, but this figure was partially offset by higher quality loans, which require less provisions to be put aside for future charge-offs. Next, we have to take a look at the other operating expenses, which only increased by 10.2%, or $8 million. And this, much like last quarter, mainly had to do with the required costs associated with growing the company's loan portfolio. And also like the other operating expenses, depreciation and amortization increased for the same reason as last quarter, i.e. there were more physical locations open in Q2 of the prior year, and a greater number of intangible assets that had to be amortized. And the increase here came in at about 5.7%. So all in all, we're looking at revenues that grew by 20.4% and total operating expenses that grew by 24.6%, which of course isn't the best thing ever, especially if this trend is sustained over the long term. However, with revenues that are multiple times larger than the expenses, Goeasy did still realize quarterly adjusted earnings per share of $3.28, which is up nearly 16% from last year's second quarter. And just as a quick reminder for why I prefer to look at the earnings per share as opposed to the free cash flows per share when measuring for the profitability of a company like Goeasy's, this is just because Goeasy's business model involves lending out large sums of money that will be paid back over the period of several years. Meanwhile, the free cash flow metric measures how much money went in versus came out of the operating business. So, since Goeasy is lending out large amounts of money up front and taking in small repayments plus interest over a longer term, the free cash flow metric makes the company look like it's losing money since it does not take into account the future value of the loans. Anyway, moving on to the liquidity, it's here that we can see how much immediate money the company has access to. And it looks like Goeasy currently has a carrying value on its borrowed debts of just over $2.5 billion. And the company has access to $820.8 million more of debt and an additional $74.5 million sitting in cash. This means that Goeasy took out about $180 million of debt within the quarter. But at least most of this is hedged to ensure that the majority of the drawn debt is set at a fixed rate. And even if Goeasy were to fully draw down on their credit facilities, their average interest rate would only be bumped up from 5.6% to about 5.9%, which isn't too bad considering the recent federal rate hikes and the business model risk inherent to lending money to non-prime borrowers. In my opinion, this uncertainty surrounding the security of the loans is the biggest risk facing the business, but it seems like Goeasy may be getting close to a point wherein the company will be able to pivot from using debt to utilizing only the extra cash brought in by the business to fund the growth of the loan book. See, on the conference call, when an analyst asked about potentially issuing more shares at the current higher stock price in order to shore up some quick extra cash to use in the business, Jason Mullins, the CEO, stated that the current leverage position is comfortable and that Goeasy isn't planning on issuing any more shares. And on top of that, he said that the company is looking to delever and grow the business without the use of additional debt. If that's the case, then Goeasy may quickly find itself in a position where it's considered to be a much more safe and secure business. However, I'd like to add my own 2 cents in, since it could be interpreted that Goeasy is not going to use any more debt at all, and that the company is going to start paying down its borrowings as early as next quarter. Personally, I think that when Mullins said that he wants to de-lever the balance sheet, this was intended as more of a long-term plan for the company, and that by not using additional debt, I believe what he really meant was that Goeasy won't be looking to acquire more debt than is already available within the revolving credit facility, meaning that the company won't be looking to expand their revolver or issue more bonds in the future. That said, my interpretation could be wrong, but I just don't think that next quarter's 60 or so million projected dollars of earnings will be enough to sustain the current customer growth rate, though I am enthusiastic at the thought of being proven wrong on my prediction. Now, this quarter net locations came in even, with 2 of the faster growing and more profitable Easy Financial locations being opened versus 2 of the Easy Home locations that were closed. Noting that physical locations are only one part of the way that the company earns its money, and this quarter we received some pretty big news on the alternative income sources. First, Goeasy added nearly 1,000 new merchants into its network, which will allow the company to offer its loans directly to customers at the point of sale. And this growth, despite the competition in the space, is really nice to see. And I do have a little bit more to say on the matter once we finish up with the report. Next, in addition to all of that, the CEO announced that the company will be officially rolling out the completed version of the Goeasy Connect mobile app in the next quarter. This app has been specially designed to offer users direct access to all of the company's credit products through an easy-to-use interface that presents users with pre-approved credit offers that are tailored to benefit the individual customer and their needs. Combining these 2 big updates with the already growing number of loan applicants should at least ensure that the company's past growth trend continues into the next few quarters as more consumers become familiar with the Easy Financial brand and its offerings. Getting into the long-term outlook, every single metric is the exact same as it was last quarter. No changes at all. However, on the conference call, the CEO did say that their forecasts are quite conservative and that he is projecting that Goeasy will either meet or exceed the high end of the loan book forecasts for 2023. And while we are on the topic of the company's outlook, we did get a bit of an update on the federal regulations that are set to reduce the maximum legal APR in Canada to 35%. On the conference call, it was stated that the company expects the regulations to be published sometime between the fall and early winter of this year, and that the implementation date for these new rate limitations are conservatively being assumed to start in early 2024. However, if the legislative process ends up taking longer, then Goeasy will likely have stronger than projected future earnings. Noting that, it is important to be aware that this is conjecture on the management team's part, and time-wise, nothing pertaining to the government's process is going to be for certain. What is for certain is that Goeasy has continued to get ahead of the regulations by once again lowering the average interest rates owed by customers, which is now at 30.1%, down from 30.2% last quarter. And this came at a time when federal interest rates increased, which speaks to how much stronger the company's loan book is becoming. And on that note, the CEO also mentioned that this interest rate environment is making it much harder for their smaller competitors in the lending space to find regular and cheap access to capital, which is preventing them from expanding their loan books and driving customers over to Goeasy, as was projected last quarter. Also, the pending regulatory changes are playing a small role in getting competitors to reconsider non-prime lending in Canada, which is allowing Goeasy to take additional market share. But even in the more competitive battle for point-of-sale lending, Goeasy is thriving and winning over tons of new merchants, and the CEO elaborated on this in the conference call and outlined the 5 pillars that hold Goeasy up as the best option for lending partnership. The first of these pillars is that merchants are looking to partner with a company that has strong customer approval ratings. Merchants don't want to be associated with a company that rips off or financially harms their customers, since poor affiliation choices are a surefire way to tarnish the partner's reputation and lose a return customer forever. In this area, Goeasy is widely known as the largest non-prime lender with a high approval rating, in a space where high approval ratings are otherwise virtually non-existent. Second, merchants want to see competitive APRs for its customers. Obviously, if a lender doesn't offer competitive rates, customers are going to be much less likely to finance their purchases at the point of sale, which means that the merchant won't be collecting as many commissions on loans. That having been said, Goeasy offers the most transparent and customizable loans at some of the best rates in the space. Third is the ability to underwrite loans quickly, because the longer customers have to wait, the more likely they are to decide against financing or even purchasing altogether. Once again, Goeasy thrives here thanks to their advanced modeling and data analytics from their massive customer data repository, which allows them to offer eligibility and qualify customers instantly based on their proprietary customer adjudication and behavioral risk scores. Fourth should be a fairly obvious one. The lending partner needs to have good merchant support, and thanks to the scale of Goeasy's business, the company has a dedicated service available to merchants 24/7. Finally, potential merchant partners are looking to partner with a company that has a strong dealer reserve and competitive commission rates on loans. And with nearly $900 million in total liquidity on top of strong earnings, merchants can rest assured that Goeasy will not struggle to pay them their commissions. And again, thanks to the company's large scale, they're able to offer very competitive rates while also turning a nice profit for themselves. Thanks in large part to the LendCare acquisition in 2021, Goeasy was able to bring in over 15 years of experience to the Easy Financial team to innovate and execute on strengthening these 5 pillars, which is why Goeasy is constantly winning over more and more merchants each and every quarter, which is awesome to see and will hopefully lead to even more quarters like this one. That said, does this quarter's strong numbers justify a 23% increase in the stock's price? Well, the 2 major risks that I outlined in last quarter's video are still as present as they were last time around. The potential for additional future regulation is still a worry that would likely have a very negative impact on the company's business model. And the more serious risk of a lasting recession could potentially destroy Goeasy if it ends up being the case that its customers can't afford to pay back their loans and net charge-offs spike, making it difficult for Goeasy to pay their own lower interest rate debts. And there is a lot of them to pay. Noting that, the management does seem to be working towards dealing with these risks. In the first case, by continuing to lower the average APR of its customers to levels below the impending regulatory maximum. And in the latter case, by increasing the percentage of secured loans, as well as discussing plans for delevering the balance sheet. Now, discussions and plans are definitely a good start, but I need to see action and execution before I'm willing to look at the company's downside circumstances in a more favorable light. And in terms of actions, this quarter the company took out an additional $180 million of debt. But this was done to grow the company's loan book, and it should be noted that this growth is leading to positive earnings growth, which does contain some value that offsets the risk scenario. The big issue with Goeasy's stock price right now, unfortunately, is the huge run-up since last quarter. Personally, I can't justify paying the current price, knowing that there's a very real possibility that my invested capital has a reasonable likelihood of going to zero in a moderately long-lasting recession. Now, I would be a bit more comfortable paying a slightly higher price than I would have last quarter, since the business has improved the quality of its loans and improved the amount of cash earnings that it's bringing in. However, I can't justify paying more than maybe $110 for the shares as they currently stand. But the share price has been rapidly pulling away from my buying threshold. So the question now is, am I going to be selling my shares of the stock? No, I do not plan to sell any shares of Goeasy anytime soon. Even though the company has far surpassed where I'd feel comfortable buying the shares at, I still strongly believe that if the company can overcome the recession and regulatory risks, the company will be a long-term super compounder, with the possibility of becoming a 100-bagger. So, in order to get me to sell my holding, my opinion on the business's prospects would need to change, or the company would need to become supremely overvalued to the point where a lot of the future growth potential is already baked into the stock price. And right now, we're several orders of magnitude away from that, in my opinion. So for me, Goeasy is just going to be a hold for right now, but in the meantime, the stock is doing wonders for my TFSA, where I have an average cost per share of just under $64. But those aren't the only shares that I have. I'm also holding a small position in my $100 per month Canadian stock portfolio that I track here on the channel, and those shares were purchased at an average price of around $94. And that's where I'm at right now. So hopefully this has been helpful to providing you with a better understanding of the company, its earnings, and how I'm valuing the stock. That said, please be aware that my opinions on the stock are just opinions, and it is possible that I am incorrect in my assumptions. So make sure to do your own research and come to your own conclusions before making any investment decisions. I am not a financial advisor, and this video is not financial advice. I made this video for educational purposes and to highlight my own opinions. So this video should only be relied upon for inspiration to do further research into the company outlined. After all, I'm just a Canadian who likes to invest and share what I've learned with others. I hope that you found something of value in this video, and if you have, please consider sharing it with others. Thanks for watching all the way to the end, and enjoy the rest of your day.